Hi friends, in this session let us try to take up two more accounting standards and learn and revise those two standards. The standards let's take up in this session would be the impact of AS 9 and the impact of AS 11. So these two standards let us apply, let us learn through some practicalities and finally conclude our understanding. Again, it will be on a chart based mechanism, so it will be helpful for you to learn it correctly. And apart from that, as always, if any doubts, please get back to me so that we can discuss about it and learn this particular topic even better. Happy learning. With this, let us start the discussion on AS 9 and later let's go with AS 11.
Standard talks about AS 9 is revenue recognition. Practically one of the very important standards because it is one of the basis, one of the major element of any profit or loss statement about revenue. So basically because of that, this one standard is very important from the practical note. At the same time, even if any question is asked from the exam point of view also, normally a practical question is asked from the exam. A practical case study is asked. You have to decide based on the rules of AS9 and you have to give your answers accordingly. Now, when it comes to AS9 revenue recognition, the first thing is this is applicable to everyone. It's not like specification and all, it's applicable to everyone, but there are certain exclusions also. So it is applicable to all entities, but certain elements it is excluded. So exclusions. What and all are excluded? One, construction contracts are excluded because AS7 is covering for that. So construction contract revenue doesn't come over here. Next, second one is about government grants. So how do we treat them is not covered over here because AS12 is covered. Third one, leases are excluded because AS19 is covered. Fourth, insurance contracts are excluded because insurance law is a element covered over there. So because some other standard or some other law is getting covered, these elements are not covered in AS9. Now, first and the very important thing what we have to know when AS9 comes into the picture is what do we mean by the term revenue? What is revenue in a particular situation? Okay, according to AS9, what is the definition of the term revenue? Is gross inflow of what? Of cash, receivables, or any consideration then this should occur in normal course of business or occur in ordinary course of business out of number 1 sale, number 2 rendering of services, number 3 employment of enterprise resources, and this will lead to interest, royalty, dividend. So this is the definition of the term revenue. Again, wherever the technicalities are involved, I'm trying to bring up those things only. Even though we can make this in a simple language, but still in the exam you have to bring these sentences. So basically what does it tell? It tells that revenue is gross inflow of what? Of cash or debtors, receivables or any other consideration. So receivable leads to debtor, cash or other consideration. How it should come in the ordinary course of business. So any other stuff is not covered here. So ordinary course. In what way it should occur? Either by sale or by service or by employment of enterprise resources. What do you mean by that? I will give my resources to someone, that someone is going to employ that in their element, and for that he is going to give me a payment. Example, I've got excess cash. I give this cash to one of the enterprise. That enterprise employed my cash, for which interest will be given. So therefore, employment of enterprise resource means my enterprise gave my fund to someone else employed it, that is going to give me money. So it will lead to either interest or royalty or dividend, which means our entire revenue will be with 5 points: sale, service, interest, royalty, dividend. Accordingly, you have to see one by one as to how these revenue should be recognized. So starting with sale. How sale revenue should be recognized? Number one, there has to be transfer of title. So seller has to give up the title in the name of buyer. Transfer of title. Very important element is transfer of significant risk and reward. Transfer of significant risk and reward, and later it continues that seller cannot exercise any effective control. So basically, for a sale to get completed, this point is very important. What it is? Significant risk and reward of that product should be transferred. Okay, so once the seller is going to sell the product, it means reward from that product is to the buyer, risk of that product is with the buyer. I don't hold anything. Now don't bring warranty over here. Now warranty is different, it's a separate contract. We are only talking about sale. Okay, therefore try to understand, if any goods are given on sale or return basis, since significant risk and reward is not transferred, it is not considered as sale till approval is established. Once approval takes up, risk and reward is transferred, sale is complete. Because till approval, what happens? If buyer doesn't want it, he can give the goods back to me. So there is no risk and reward transfer over there. So therefore, sale or return basis is complete only when actual approval is given by the buyer. So risk and reward should be transferred. What does that mean? Seller cannot have any effective control on that product. Example, a buyer came to us and bought a product, and buyer said, for the time being you only keep the product, I will later come and collect it. Seller said, or seller cannot take any decision on this product now. Any decision has to be taken, he should ask the buyer, can I do this? Buyer says okay, then only it could be done. So therefore sale is complete, only possession is with me. So holding possession never leads to ownership. So if at all ownership shifts, at that time, even if possession is there, sale is complete. So that's how you have to understand. The third point is consideration is certain. Consideration is certain. This is going to be our third point. Okay, so this is how sale comes to an end. So first, title transfer might take place. Second, significant risk and reward should take place. Third, the consideration is certain. So if I give free of cost goods to someone, it's not sale. It's just either charity, or it is either business promotion or anything like that, but it is never going to be considered as sale. So therefore, free samples given, they are not considered as sale. It is considered as advertisement. So that's how it should be done. Then the next one, services. How to recognize revenue from services angle. Now, whenever services are involved, there are two methods in which revenue recognition will take place. One, it is called as proportionate completion and second one is completed service contract. Okay, now if at all it is proportionate completion, then revenue recognition takes up on basis of completion. So according to basis of completion, proportionate revenue is recognized. So according to the basis of completion, you are going to recognize your revenue on a proportionate basis. When proportionate completion method comes into effect, normally when more than one act is supposed to be provided. So if there are more than one act in a contract agreement or in the service agreement, at that time proportionate completion method comes up. Okay, suppose if it is completed service contract method, revenue recognition only on completion of contract. Normally it contains single act. Now example, assume that we are supposed to audit an organization for 12 months. Okay, we are supposed to audit an organization for 12 months, and therefore once I finish every month audit, I am going to give a bill to them. I am going to recognize revenue for that month. So what happened? There is more than one act in the contract. Therefore, I will recognize revenue on a proportionate basis. Assume that the total audit fee for the entire year is 1,20,000. Every month when I audit it, I will bill 10,000 rupees. So what happened? More than one act, proportionate completion. On the other way around, only single audit assignment. There is only one act, single audit assignment. When will you recognize revenue? Once you finish it. So till finishing it, you can't now break that act also into different acts. That's not possible. So therefore, it will be considered as completed service contract method. So once you complete it or significantly complete it, then only it will be allowed for you to recognize. Okay, so this is how you have to deal with these two methods. So if proportionate completion you need to apply, you have to find that the contract could be broken up into pieces. If it's not possible, you can't do it. Completed service contract, you can't break it, then do it on a bundled way. Installation of machinery is a service for us. If there is only one machine to install, it is completed service contract. Once you install it, then only recognize revenue. If there are 15 machines to install, every machine is proportionate. So that's how these two methods are done. So case to case analysis you have to do. Then finally, for both of them, one single rule, consideration should be certain. Okay, so this is how service revenue should be recognized. Now the next one, those three stuff. One is interest, royalty, dividend. Now, how interest revenue should be recognized? Number, the requirement of interest revenue is it is done on time basis. It is done on time basis based on rate. So based on interest rate, it is recorded on time basis. Example, I take a loan on 1st January 2019 and we follow financial year. So interest comes only for 3 months as on the balance sheet date. Why? Because time proportion. Interest is done on time basis, PTR, which we normally consider. Royalty. Now, what do you mean by royalty? First of all, what is the meaning of royalty? Royalty is basically consideration given for intellectual property, IP. So if any intellectual property is involved, if a consideration is given on intellectual property, we call that as royalty. Now, whenever royalty is considered how to recognize revenue, it is done on accrual basis according to agreement. Now, some agreements will work in some ways or Different type of agreement can happen. According to agreement, do it on accrual basis. Example, one agreement tells that for using your intellectual property, I will make a lump sum payment of 10 lakh. So as soon as 10 lakh becomes due, I will pass an entry. Some agreements may say that I will give you 15% of all the products sold. So as soon as the products are sold, I will give you 15% out of it. So what happened now? As soon as the product keeps on getting sold, amount kept on getting accrued. So depending upon the agreement, you will recognize royalty income. Third one, how do you recognize dividend income? Dividend income is recognized when right to receive dividend is established. When right to receive dividend is established. So as a shareholder, as soon as the company ends its financial year, whether right to receive dividend comes, no. As soon as company earns profit, whether right to receive dividend comes, no. As soon as directors are going to propose it in their board meeting, whether right to receive dividend arises, no. When does right to receive dividend arises? On the date of declaration of dividend. Because once dividend is declared, then according to company law, it should be paid within 30 days. Once dividend declared, it cannot be retracted back. So therefore, dividend declaration date is called as right to receive dividend. So as soon as it is established, you have to consider it. Again, common point for all these three is consideration is certain. So now 5 revenue, we saw how it should be recognized. So sale, significant risk and reward transfer. Service, according to agreement, either go for completed service contract or proportionate completion. Third, interest, time, royalty, accrual based on agreement. Dividend, right to receive dividend arises. So these are the 5 types of revenue which should be considered for revenue recognition concept. Now, in all these things what we discussed, one simple line was there, that consideration should be certain. So now the last segment of AS9 is what happens if there is uncertainty in consideration. If there is uncertainty, consideration is uncertain, what should I do? So if consideration is uncertain, it's very, very important that I will now break that uncertainty in consideration into 2 points. One, before revenue recognition, after revenue recognition. So for example, there is one business partners of mine, or one our business partner who is in total financial trouble. You want to help them. So what happened? You gave the goods on credit. Your partner said, I don't know when I can repay the amount back to you. You said, okay, no problem. But you gave it for support. At that time, what happened? Before revenue recognition itself, there is uncertainty. You don't know when you are going to get. You don't know whether you will get it or not in the first place. One example. Second example. Assume that there is a credit period of 1 month, and if any buyer is going to go beyond the credit period, there is a 15% interest rate. Till now, all your buyers have paid everything on time. There is no experience of yours where interest is collected. So therefore what happened? Interest is uncertain before revenue recognition itself. So whenever there is before revenue recognition uncertainty, you don't know whether you will receive the consideration or not, then you have to postpone revenue recognition. Till when? Till certainty is established. So till certainty is established, you should postpone revenue recognition. Don't recognize it now. Once it is certain, so certain is basically the ability to collect. So once you are sure that you are going to get your consideration, then consider it for revenue recognition. Till then, postpone it. Another example, which is for after revenue recognition. You have already made the sale. So all the sale rules were followed. You have made the sale, but it is sold on credit. You know that it is gross inflow of cash, receivable, other consideration. So even receivable is also a revenue only. So you have already recognized revenue. After you made the sale, your buyer is in financial trouble. Now what happened? You have already recognized the revenue. Now it is turning uncertain. At that time, what should be done? At that time, the point to be understood is create separate provision but never reverse revenue. Whatever revenue is recognized, you are never supposed to reverse it. So therefore, now think about it. You have already made the sale. Your buyer cannot pay you the money. You will never reverse sale. You will create bad debt. So according to AS9, you are never allowed to reverse a revenue. You should create a provision for it. So that's how you have to deal with uncertainty. So if there is uncertainty in consideration before revenue recognition itself, then don't recognize. Postpone it till certainty. After revenue recognition, create a provision. Never reverse it. So that's how AS9 comes into the effect. Okay. So what is revenue? Sales, service, all these things, how it is covered up. Uncertainty effect comes into the effect. What should be done? That's how AS9 theory should be taken up. Now again, let's move on to a problem based on AS9. We'll see how it should be done. First, I will read the first question. This is RTP question. I'm correct. Yes. Fashion Limited is engaged in manufacturing of ready-made garments. They provide you the following information on 31st March 19. Case study. On 15 January 2019, garments worth rupees 4 lakh were sent to Anand on consignment basis, of which 25% garments unsold were lying with Anand as on 31st March 2019. Garments worth rupees 1,95,000 were sold to Shine Boutique on 25th March 2019, but at the request of Shine Boutique, these were delivered on 15th April 2019. You are required to advise the accountant of Fashion Limited the amount to be recognized as revenue in above cases in context of AS. So accordingly, if we check the first one, 4 lakh is sold to or sent to Anand on consignment basis. Okay, 25% is unsold. So this basically means there are two situations here. Number one, sale made by us, which is Fashion Limited, to Anand on consignment basis. So if any goods are shifted by Fashion Limited to Anand on consignment, is it a sale? The answer is no. Why? Because there is no significant risk and reward transfer, because consignee, which is Anand, is only my agent. So when can you recognize sale? Only when Anand makes the sale to a third party. So third party sales, when it takes place, then only it will be considered as sale. Now if you could see, Anand has 25% unsold, which means 75% is sold. So therefore your revenue recognition will be 4 lakh into 75%. I hope it is clear. Anything in consignment is not a sale because significant risk and reward is not transferred. Second, even from that point of view also, 25% is still with the consignee, 75% is sold, so therefore recognize 75%. Then second one, 1,95,000 is sold to Shine Boutique on 25th March, but at the request of the buyer, these were delivered on 15th April. So what does that mean? I have already made the sale, but the buyer requested me not to deliver it till April. It means what? Possession is with me, but the sale is already done. Okay, why? Because can I take any decision on this particular goods from now on? No. If I have to take any decision, I have to call the buyer and then ask, which means my effective control is gone. It's not there with me, which means what happened? It is a sale. only delivery is yet to be made. So therefore 1,95,000, treat it entirely as sales. That should be done. So if you could now see the answer, first they mentioned those two conditions to be satisfied to be called as sale: significant risk and reward transfer, seller should not have any effective control on the product. Then there is certainty in the consideration. Later, if you could see, 25% is lying, so therefore recognize revenue to the extent of 75%, and consignment sale revenue should not be recognized till they are sold to a third party. So that is the answer for the first one. Second one, sale is complete but delivery has been postponed, so therefore recognize entire sale of 1,95,000. So that's how the answer has to come out. Now let's move on to the next question. New Era publication publishes a monthly magazine on 15th of every month. It sells advertising space in the magazine to advertisers on the terms of 80% sale value payable in advance and the balance within 30 days of the release of the publication. The sale of space for March 2020 issue was made in February. The magazine was published on its scheduled date. It received 2,40,000 on 10th March and 60,000 on 10th April for March 2020 issue. Discuss in the context of AS9 the amount of revenue to be recognized in the treatment of the amount received from advertisers for the year ending 31/3/2020. What will be the treatment if publication is delayed till 2/4? This had come in MTP. Now the point to be understood over here, first, this is what publication. If it is publication, it is actually services. Now if rendering of services should take place, either it is proportion or completed service contract. Proportion, if at all there is more than one act in the contract. The completed service, there is only one act. If you could see here, when can you recognize revenue? When you publish it. That is your service. So once you are publishing your issue, that itself is going to be your rendering of services, which means till you publish it, do not recognize revenue. That's the entire thing. Till you publish, don't recognize revenue. And therefore, what did they say? Publishing is happening on its scheduled date. What is that scheduled date? 15th of every month. So for March 2020 issue, 15th March is the scheduled date. So that is the date of revenue recognition. So recognize revenue on 15th of March 2020. So as on 31st March 2020, how much revenue should I recognize? Entire 3 lakh. Because revenue is recognizable as soon as you have rendered your services. So 3 lakh revenue will be recognized, and 60,000 which is collected on 10th April will become my receivable balance as on 31st March. It's my receivable. However, if it is getting published on 2nd of April, then what happens? Revenue recognition will become on 2nd of April. Till publication, you are not supposed to consider revenue. So 2nd of April will become your revenue recognition date. So whatever you collected on 10th of April, sorry, 10th of March, to the extent of 2,40,000 is advance collected as on 31st of March, because now revenue recognition date is passed on to 2nd April. So till then, consider it as advance received, 2nd April, recognize revenue, and then this will be adjusted. So that's how you have to deal with the question. So if you could look into the answer, it is going to tell you the same thing. Since lack of time, I'm not reading the entire answer, but if you could look into it, whatever I have explained, the same thing will be there in the answer. So with this, we finished off with the AS9 element also. So everything will be covered in either of these 5. Their sale or service or interest, royalty, dividend. Other than these 5, nothing will be asked. So if at all it is covered, check into individual rules. Check whether consideration is certain. Then you can recognize revenue. If it is uncertain, then 2 conditions. Either before revenue recognition or after revenue recognition. Before, postpone. After, create a provision. So that's how you have to take judgment call when it comes to AS9 accounting standard. Deals with effect of changes in foreign exchange rates Now, what is the title all about and how are we supposed to interpret them? So basically, nowadays it's very common that any enterprise might have a transaction involved in foreign currency. So say if I'm in India, INR is something which is going to function as a local currency in India, but they may have a transaction under USD as well, AUD as well, pounds, euro, whatever it is. At that time, what happened? There is a foreign currency impact. Now, whenever there is a foreign currency impact, how are you going to bring it in the books of accounts? So those things are covered under this standard. So it's not a standard which is applicable for a particular enterprise as such. It is applicable for everybody, whoever is involved in foreign currency transactions. So this particular standard now totally talks about how foreign currency transactions should be brought in the books of accounts. If there is any changes in the foreign currency rates, then how are we supposed to account it in the books of accounts? So these are the coverage area what we are trying to learn. At the beginning, when we learn about this standard, two important terms are considered for us. One is about reporting currency. Now, what do we mean by reporting currency? The currency in which financial statements are prepared. Okay, so the currency in which the financial statement books of accounts are prepared, we call that as reporting currency. So in India, reporting currency will be Indian rupees. In the same way, what the next term is foreign currency. The next term is foreign currency. Any currency other than reporting currency. Okay, so any currency other than reporting currency, you call it as foreign currency. So any currency other than Indian rupees in India will be a foreign currency for us. So whenever there is foreign currency, how the accounting should happen? So the entire AS 11 will be divided into three major impact. There are some other terms also which we need to learn, which I will tell you over the course of our discussion. First is about transaction rules. If there is a foreign currency transactions, how it is supposed to be accounted for. Second is in relation to operations. If there are any operations of the reporting enterprise in a foreign country, how are we supposed to bring it up? Third is about contracts. Specifically, we talk about forward contracts. So these are the three major areas in which we need to discuss AS 11 and we have to see the impact of AS 11. The first thing about transaction rules now. So if at all there is a foreign currency transactions, how it is supposed to be dealt with. Okay, the first one. Whenever there is a foreign currency transaction, it should be recorded in the books by converting into reporting currency. As simple as that. So whenever there is a foreign currency transaction, what type of foreign currency transaction might happen? You purchase goods, you sell goods, you buy a fixed asset, you take a loan. There are so many transactions which may happen in foreign currency. So almost all the normal transactions might happen in foreign currency itself, but majorly it will be purchase, sale, loan, purchase of fixed asset, etc, etc. Those things are considered under foreign currency transaction. Whenever you have a foreign currency transaction, it should be converted into reporting currency and then recorded in the books of accounts. So in books of accounts, you are not going to report it under foreign currency. In books of accounts, you are going to write it under reporting currency. Now, this reporting currency, you need to convert it. How do you convert it? For conversion, consider exchange rate.
Now, what do you mean by exchange rate? Exchange rate are those rates which is utilized to convert one currency to the other. So basically, if I want to purchase $1, say I may have to pay 70 rupees. That is the exchange rate now. So $1 is equal to rupees 70 is the exchange rate. So you need to consider exchange rate on what date? On date of transaction. Now, why are we giving so much of importance? Because we know one characteristic that exchange rates are fluctuating in nature. So one day exchange rates may not be the same on the next day itself. It might change. At least certain slight changes will obviously be there. So because of that, which exchange rate should I consider? The date of writing the transaction or recording it in the books, or the date of entering into the transaction, etc., etc. For that, they said on the date of transaction, whatever exchange rates you have, consider that for conversion purpose. Okay. Now a question comes, if at all the frequency of transactions are more, okay, you may understand that says there are some entities which may have small transactions in foreign currency. There might be certain entities which may have large transactions, in the sense the number of transactions might be very much. So if the frequency of the transaction are high, at that time they may opt an average rate for exchange rate purpose. Now, what do you mean by an average rate? They take the average of say 1 week exchange rates or 1 month exchange rates depending upon the frequency. So if at all it is frequent in nature, they may go with 1 month also. Normally they go with 1 week and all, whereby 1 week exchange rates. Either they will consider mode most of the time, the number of times the exchange rates has got repeated, and accordingly they will consider one rate and apply it. We call them as average rate, which is allowed. If at all it is not so frequent, consider the date of transaction, which is the safest one. Now, it doesn't mean that applying average rate is compulsory. It's not compulsory, but if at all it is very difficult to track each and every day exchange rates, it's better to go with an average rate. But this is how you have to go for the transaction rules, whereby whatever transaction is entered into, convert the foreign currency into reporting currency, consider the exchange rate on the date of transaction. Now, after this, what happens is, suppose if at all this particular transactions, there will be settlement altogether, or this transactions could have a future. What is that future? Either it will be settled in current year, or it will be settled in next year. Now, sometimes the transactions might be settled then and there. The point which I want to make over here is, assume that I'm going to make a credit purchase. Now, if you are making a credit purchase, on the date of purchase, you are not closing the transaction. You are not paying them off. You are just buying it. So the entry will be what? Purchases account debit to creditor's account. Later, this creditor is supposed to be paid, which means it will be paid in a future date. It will be settled in a future date. Now that point is, will that be settled in the current year? Will that be settled in the next year? Both of them are possible. It's not like you have to settle it in the current year only. There is nothing like that. So because of that, if it is settled in the current year, if it is settled in the next year, what are the impact? If it is settled in the current year itself, then directly consider the exchange rate difference. Directly consider the exchange rate difference. We'll talk about exchange rate difference in detail. Suppose if it is settled in the next year, then one of the impact is balance sheet date. Very important stuff. So if at all it is going to be settled in future, in the next year, in between there will be a balance sheet date. For example, say we are going with financial year 2018-19. We have made a credit purchases on 1st March 2019. Last month we have made a credit purchase. The payment is supposed to be provided as on 31/5/2019, which is in the next year.
Problem is, in between, you will have 31/3/2019, which is your balance sheet date. So, if at all there is any foreign currency transaction which may reflect on the balance sheet. So, balance sheet date, what happens? First, consider those balance sheet items. Consider balance sheet items. Now, all the accounts are not balance sheet items. I am telling you only the balance sheet items are supposed to be considered. Okay, all the other ones other than balance sheet items, what do you find? You will find P&L items. Ignore P&L items because it will be directly shifted to P&L in the account what you have recorded for. I'll give you an example and tell you, so don't worry on that. Now, if at all it is a balance sheet item, then it should be classified into two things. One, you classify either it as monetary item or non-monetary item. There is a specific definition for it. Do not go under the impression that monetary means without money, monetary is with money, non-monetary without money. No. What do we mean by monetary item? Items having fixed and determinable effect. The items which are fixed and determinable, you call that as a monetary item. The value in that item will remain fixed. It is never going to fluctuate. Example, debtors. So I will give you certain examples which are very famous. Debtors, creditors, loan, then cash and bank. These are common monetary items, which means the underlying value of these items will never change. Debtor, for example, you have got a debtor of 50,000 rupees. No matter how many days it may pass, 50,000 will remain 50,000. Only thing is, upon that 50,000, they may have to pay certain interest if they go beyond credit period. But 50,000 principal value will remain the same. Same stuff will apply to creditor, same stuff will apply to loan, for cash, for bank. These things are called as monetary items. Okay. Now, what do you mean by non-monetary then, other than monetary items? Not fixed and determinable. Not fixed and determinable, as simple as that. Now, for these examples, all the other ones, fixed assets, inventory, investments, etc. Okay, because fixed assets, if you wait for 1 year, automatically the underlying value will reduce. You call that as depreciation. Inventory is always fluctuating according to market effect. Investment is always fluctuating according to market effect. So all these things will be considered as non-monetary. So the key factor, value underlying should remain same. That will be monetary, other things will be non-monetary. Now, after making this bifurcation, how it is supposed to be interpreted? What does the standard tell us? If at all it is a monetary item, then restate value according to closing rate. According to closing exchange rate, restate the underlying value of those items. There is a debtor. You need to restate the value according to closing rate. So, what do you mean by closing rate then? I will write it here. Closing rate basically means exchange rate on balance sheet date. So on the balance sheet date, whatever is the exchange rate of these items or whatever is the exchange rate, these items are supposed to get restated. So that is the rule given by AS 11. If at all there is a balance sheet item which is a monetary item. Now, if at all it is a non-monetary item, if at all it is a non-monetary item, how it is supposed to be taken up then? it will again be bifurcated into two. One, we say that non-monetary item recorded at historical cost, non-monetary item recorded at fair value. Okay, there might be certain items, for example, say investments, there are chances that it may be recorded at fair value, it may be recorded at historical cost also. Say even from the fixed assets point of view, if they opt for cost model, it will be shown at historical cost. If they opt for revaluation model, it has to go through fair value. So those valuations, you might be very well concerned or very well knowing about it. So accordingly, if at all the asset is shown, or if an item is shown at historical cost, what should be done? If an item is shown at fair value, what should be done? If at all an item is shown at historical cost, then it will be recorded at historical price itself. Do not make any restatement. It will be recorded at historical cost itself. So if it's a non-monetary item which is historical cost nature, keep it at historical cost only. Example, we purchased machinery. Machinery is purchased 3 years ago. Chalega. 3 years ago, what was the amount at which you recorded? Because initial transaction, right? So initial transaction, whatever amount you had recorded, continue the same amount. Don't change it. Okay, keep the same amount. But if at all it is shown at fair value, then it will be recorded at exchange rate on date of determining fair value. So if at all you have got a balance sheet item which will be recorded at fair value, it will be recorded at the exchange rate on the date of deriving the fair value. So date of deriving, if it is historical cost, continue with historical cost. Date of deriving, if it is according to fair value, then fair value determination date will be considered for foreign currency purposes. Example, inventory. Say inventory is supposed to get recorded at fair value. Okay, for example, inventory is supposed to get recorded at fair value. The date of deriving the fair value is 31st March. Consider the exchange rate as on 31st March. So the date of deriving the fair value, consider the exchange rate. So this is how you have to deal with the balance sheet items. Okay, so if it's a monetary item, restate it according to closing rate. If it is non-monetary item, do not restate it. Normally, do not restate it. So if it is historical cost, keep it at historical cost. If it is at fair value, then the exchange rate on the date of derivation of fair value. That will be considered for the purpose of determining your elements of foreign currencies. Now, the point continues is that if you could see the monetary item, it should be restated according to closing rate. So because of that, what happened? There arose exchange rate difference again. Okay, if it is at historical cost, then there won't be any ERD, there won't be any exchange rate difference. If it is at fair value, the chances are there that there will be exchange rate difference. Why? Because your date of historical cost and date of deriving fair values are different. So therefore, there are chances that there is exchange rate difference. So what do you mean by exchange rate difference? Exchange rate difference is the price difference or the exchange difference happening between determination of two dates. So you purchased it on 1st March. You are restating as on 31st of March. Those two rates will not be the same. What happened then? The difference is called as exchange rate difference. Okay. So exchange rate difference arose if the settlement is happening between two dates. You could see here, I will underline that. It arose over here also. Then even in balance sheet also, there are chances that exchange rate difference will arise. Okay, then what about settlement time then? See, balance sheet, if it is settled in the next year, then on the balance sheet date, there will be certain elements. Even on the settlement date, you are actually going to make the payment. The exchange rates on the balance sheet date and the settlement date will never remain the same. So again, what happened? ERD came into the picture. So exchange rate differences will start popping up. So only in the case of non-monetary historical cost, you will not find exchange rate difference. Other than that, you have to hope that your uh, date of transaction and date of derivation, the exchange rate shouldn't change. That normally doesn't happen. So exchange rate differences will arise in those particular situations. Now at that time, if exchange rate differences keeps on arising, so what are we learning now? Settlement is happening. If it is in between, there is a balance sheet date, then bifurcate them as monetary, non-monetary, then again start applying the rules. Again, there is exchange rate difference arising. Settlement time, again exchange rate difference will arise. So exchange rate difference is now keep on coming up because every day the rates of exchange keeps on getting changed. So now because of that, exchange rate differences comes into the picture. How are we supposed to deal with it? Whenever there is an exchange rate difference, it should be transferred to P&L account. So wherever there is an exchange rate difference, directly shift that to P&L account. That is how you have to determine or you have to understand the exchange rate difference perspective. But there is one more thing which I want to tell. There is an MCA notification. Now, what does the MCA notification say? It says that if at all there is a company, it is going to purchase depreciable fixed asset. Okay, it's going to purchase depreciable fixed asset. How do they get the funds? Out of foreign currency monetary loan. Basically, foreign currency loan. Loan is always monetary in nature, so we call it as foreign currency monetary loan. So basically what is happening? There is a company. It has purchased a depreciable fixed asset. From which funds? Out of foreign currency monetary loan. Now try to understand, depreciable fixed asset is a non-monetary item because fixed asset, it's a non-monetary item. But loan is a monetary item. If it is a monetary item, restatement is compulsory. If there is restatement, exchange rate difference will arise. So therefore, what they say is, they gives us an alternative. From the loan, if there is any ERD coming into the picture, there is any exchange rate coming into the picture, they have got two alternatives. Alternative one, shift it to P&L. Normal stuff, shift it to P&L, which is the normal uh, treatment given by the standard. Otherwise, alternative two, make the changes to cost of asset. Instead of transferring the exchange rate difference to P&L account, the company can transfer the exchange rate difference, adjust the exchange rate difference to cost of the asset. Reason being, exchange rate difference, there is no control over the organization. It's a universal factor. So because of that, directly if you have to shift it to P&L, sometimes there are chances that company may suffer huge losses. So for that, they gave an alternative. It said, if you want, you can directly go and adjust it to asset. What happens then? Proportionate depreciation will arise. That's okay. Instead of showing the entire loss right now, you can proportionately show it over a period of time. That is totally fine. So therefore, this option has been given by Ministry of Corporate Affairs. It said it can be adjusted, or it can adjust the exchange rate difference to the cost of the asset. That is how the alternatives has been given for us. So now I will take up one example to tell you all these exchange rate difference mechanism, and let's try to understand whatever we have learned in detail. So say there is a credit sales, or else I'll go with credit purchases of $10,000, and this is happening on say 1st of January 2019. Okay, now After that, as on balance sheet date, it is not settled, then it is settled on say 1/5/2019. Okay, so 1/1/2019 date of transaction. It is not settled by the balance sheet date, so it will stay on the balance sheet date. It is settled in the next year, 1/5/2019. Okay, as soon as this type of situation is given, the first thing what you need to check is what are the exchange rates. So 1/1/2019, let's assume that $1 is equal to rupees 60. Then 31/3/2019, the balance sheet date, let's assume that $1 is equal to rupees 65. 1/5/2019, let's assume that $1 is equal to rupees 62. Okay, this is the situation, and let's try to analyze all the three dates. Okay, now how are we supposed to deal with it? I'll try to explain it through a journal entry itself so that it becomes easy for you people. So basically on 1/1/2019, when I'm actually making the purchases, I need to pass an entry for credit purchase. What entry should I pass? Purchases account debit to creditors account. But what is the rule tells? You shouldn't write the entry in foreign currency. You should convert that to reporting currency. Okay, how? Exchange rate. What date? Date of transaction. What is that? 60 rupees. So basically $10,000 we have. $10,000 into 60 rupees I have to consider. So this is going to be 6 lakh. 6 lakh. Okay. Now after that, balance sheet date came into the picture. Now try to analyze what type of accounts you have created. Purchases account you created, that is normally an expense account. So purchases account, where will that go? Purchases account will be shifted to P&L. Will this come in balance sheet? No. So it's already recorded at 6 lakh. It will directly go to P&L, and then you apply your all expense income stuff and you calculate the profit. So leave it. But creditors will come in the balance sheet. Whatever element comes in the balance sheet, you have to make it job. What is that? Convert or classify them into monetary or non-monetary. So that effect will come only for balance sheet item. For P&L item, forget about it. It will directly go to P&L. You calculate profits out of it. So therefore, creditors is a balance sheet item. Now you have to decide which one is this, monetary, non-monetary. Creditor, fixed and determinable value. So it is a monetary item. Now apply monetary item rules of AS11. What does it tell? Monetary item should be restated on the balance sheet date. Monetary item restated on the balance sheet date. So because of that, what should we do then? You have to consider balance sheet date ka exchange rate. How much is that? 65. You should now restate 60 rupee exchange rate creditors to 65 rupees exchange rate creditors. So for that reason now, because of this, what's happening? 60 rupee creditor is now treated as 65 rupees. 5 rupee creditor is increasing. Creditor is a liability. If liability is supposed to increase, then it has to be credited. How much? 2 creditors for 5 rupees, $10,000. So 50,000 credited. Okay, so basically what did I do? $10,000 into 65 minus 60. That is how I have considered it. Debit is given to what? Debit is given to exchange rate difference account. Different people will create different types of accounts. Let's create it as ERD account. Exchange rate difference account, 50,000 rupees. Like this, for all the transaction, they keep on doing exchange rate differences. Ultimately, since I will be considering only one transaction, it will be shifted to P&L. P&L account debit to ERD. Again for 50,000 rupees. So the ultimate exchange rate difference what they have after making all the adjustments will be shifted to P&L. P&L will take that particular amount. Okay. Now this is 31/3/2019 ka case. Because of this, now look into the transaction you have done here. Because of this, what happened? The revised balance of creditors are now 6,50,000, which is basically at 65 rupees. Because in first day you calculated creditor at 60. For that, now you added 5 rupees. So now it is at 65, which is what the balance sheet date. Okay, now comes the next year on 1/5/2019. What are you doing? You are paying them off. What is the entry for payment? The entry for payment is creditors account debit to bank account. This is the entry we have to pass. Now try to understand. The entire creditors are paid, which means the value at which creditor is created is at 65, which means the amount of creditor closure is 6,50,000 because the entire amount of creditors are paid off. So 6,50,000 entire creditor will be closed. But what is the price at which you paid? You paid at 63 rupees because as on 1/5/2019, sorry, 62. As on 1/5/2019, the exchange rate is 62. So it's paid at 62 rupees. Which means for bank, how much will that apply? Bank, it will apply 6,20,000. So recognized creditor was 65 rupee, but payment is made at 62. You paid less. The difference will go where again? It will go to ERD. This is your settlement date ERD I mentioned. The time of settlement, the exchange rates doesn't match. At that time, shift that exchange rate difference to ERD account. Ultimately, what will we do? Either on the same date or at the end of the year, this again ERD will be shifted. This time it is debit because it is credited over here to P&L for 30,000. So this is how you have to deal with the exchange rate differences mechanism. Thereby, first date of transaction, initial transaction will be shown. Afterwards, you have to consider balance sheet item. If it is coming on balance sheet item, then consider it off. If again monetary, non-monetary, if it's monetary, restatement. Again exchange rate difference arose. This exchange rate difference will be shifted to P&L. Settlement time, again if there is an exchange rate difference, again shifted to P&L. So that's how you have to deal with it. Major problem what students will create in the exam is that they will try to directly compare 60 and 62. That shouldn't happen. Because if at all the settlement is happening in the next year, then in between, if it's a monetary item, there is a balance sheet date. You will restate it if it's a monetary item. So therefore, the comparison for the next year is between 65 and 62 and not 60 and 60. So its comparison is like 60 and 65, 65 and 62. So that is one careful point which you have to remember. So this is how you have to deal with the element of exchange rate differences. If I have to give you that one example that is in connection to that MCA notification I mentioned, suppose there is a fixed asset purchased of, I will go with a smaller amount for our calculation purpose, $100 by taking a foreign currency loan. Okay, assume that the date of loan is 1/4/2018. Okay, 31/3/2019 balance sheet date, exchange rate is 64. Here say it is 60. Exchange rate is 64, over there it is 60. How do you deal with it? First, for date of purchase, the entry you are going to pass is fixed asset account debit to foreign currency loan. Okay, and it will be recorded at 60 rupees, date of transaction. So 100 into 60, 6,000 rupees. Afterwards, balance sheet date came. So because of that, what happened now? Fixed asset is non-monetary. Do not restate. It will be shown at historical cost. So 6,000 is the value at which fixed asset will be shown. However, this is non-monetary. This will come in balance sheet, but it's non-monetary. Foreign currency loan is monetary, right? It will come in balance sheet as liability and it's a monetary item. So therefore, restatement is compulsory. So 60 rupees should be converted to 64. Now, 64 matlab basically what happened? It's a loan and it's a liability. Liability is increasing. So what should I do? To foreign currency loan. Debit is given for what? Again, ERD. So ERD account debit to foreign currency loan. Now, at what price? It is 64 minus 60 into $100. So it became 400 rupees. Okay, then this ERD should be shifted, right? So this ERD will be to ERD because over there it was debit, and this time either you will consider this as P&L account debit or you can consider it as fixed asset account debit. Why is that? What is the condition? You acquire depreciable fixed asset out of foreign currency loan, then exchange rate difference can be adjusted to cost of the asset. So over here either shift it to P&L or fixed asset, anything is fine. 400. If you shift it to P&L, then P&L will show a loss of 400. If you shift it to cost of the asset, now cost of the asset got restated to 6400. Okay, point to be remembered is every asset this thing can be chosen. It's not like class of asset and all like AS10. Every asset they can choose this particular option, but once an option is chosen, it can never be reversed. Okay, 1 year you will go with adjusting to cost of the asset, then do you want to go with P&L? No, that's not allowed. Particular asset specific, once you chose this notification, then don't change it. You have to follow it till the end. So that's how you have to deal with the exchange rate mechanism over here. So with this, transaction related elements are over. So this is how transactions are supposed to be dealt with when it comes to AS11. So be careful with those balance sheet date, monetary, non-monetary items. So once this transaction element is over, the second effect what we have is operations related element. So how does this operations related element is supposed to function? Whenever operations comes into effect, translation rules are going to apply. Now basically what is the translation rules? There is an operation outside the country. So there is one holding entity over here, main entity. It has an operation outside the country. So therefore you have to translate that outside the country effect into the main entity. So therefore we call them as translation rules. Okay, two terms are very important here. One is reporting enterprise, the enterprise which is going to report its results, which is my main entity, and foreign operation, the operation which is staying in the foreign country, is sub entity. And ultimately you are supposed to translate foreign operation effect into reporting enterprise. So whatever has happened in foreign operation, it obviously will be entered in foreign currency. That should be translated and merged with reporting enterprise. So that is the entire logic which is applicable under operation mechanism. Now, when it comes to the translation point of view, foreign operations will be divided into two types. One is called as integral foreign operations, and the second one is non-integral foreign operations. Now, what do we mean by integral foreign operations? Basically, the activities has integral part in reporting enterprise. Activities has integral part in reporting enterprise. We call them as integral foreign operation. So whatever operations, whatever transactions, whatever is entered by the foreign operation, the activities has got an integral part in the reporting enterprise. They will be called as integral foreign operation. Therefore, the reporting enterprise will have utmost control over these operations. They totally control these operations. So therefore, we call them as integral foreign operation. Okay. Now, example for these integral foreign operation automatically will be branches. So basically, if at all there is a foreign branch, at that time what happens? Branch in itself does not have a separate legal entity, which means whatever branch it does is integral part of reporting enterprise, head office. So whatever branch does, it's head office point of view. So therefore, it became an integral foreign operation. Okay. Now, whenever there is an integral foreign operation, how does translation rule applicable? How do you apply the translation rules? For that, what we say is, it's as if transactions are entered by reporting enterprise itself. Okay, so if you now imagine the branch head office point of view, whatever transaction branch enters into, head office is answerable, because branch does not have a separate entity. Whatever branch does is always on behalf of the head office. So therefore, automatically what happened? Head office, it's as if head office is entering into the transaction rather than a branch. Because branch is not separate, head office is not separate. They are the same entity. And head office is the main entity. So whatever branch does, it's as if head office is doing it. So under integral foreign operation, what happens? Whatever that integral foreign operation does, it's as if reporting enterprise did it. So therefore, when it comes to the translation rules, we say transaction rules is equal to translation rules. So whatever transaction rules you have learnt before, the same rule is applicable over here as well. So date of transaction, after if at all date of transactions are many, then go with average rate, then balance sheet date, monetary, non-monetary, all these things. Whenever restatement comes into the picture, what happens? Automatically ERD will also arise, exchange rate difference will come. What should we do with exchange rate difference under integral foreign operation? Shift it to P&L account. So that's how you have to deal with integral foreign operations. So point to be understood, number one, integral foreign operation, it forms part of reporting enterprise. It is an integral part of reporting enterprise. Second, it has utmost control. So therefore, after that, when it comes to translation, it's as if reporting enterprise entered into such transactions. So therefore, all the transaction rules are directly applicable over here. Finally, if there is any ERD, it is shifted to P&L. So this is our integral foreign operation requirement. So now we have to start with, what do we mean by non-integral foreign operation? So first, they are other than integral foreign operation. Okay, which basically means it does not form integral part of the organization and all those stuff, which means there is no utmost control. So there is some sort of control, but not total control. Okay, the other entity will have decision of its own. You are going to have an influence or you control their decision, but not totally. To the extent possible, you will control it, but not in total. So the best example when it comes to non-integral operation is subsidiary, associate, subsidiary, joint ventures, etc. But I will consider subsidiary over here for remembering purpose. Now think about subsidiary. What is going to happen over there? Holding company will control subsidiary, but not 100%. To the extent of their voting rights, they control it. So therefore, yes, I agree that holding company will control them, but not to the total extent. So they will be called as non-integral foreign operation. So basically, to that extent, there is control, but not total control exercising. Now, the point to be considered when it comes to translation point of view. Here, now try to understand certain simple logic. In branch, which came in integral foreign operation, whatever branch performs, it's as if head office is going to perform, because there is no separate entity concept over there. But when it comes to subsidiary, what happens? Subsidiaries assets are subsidiaries assets. It's not holding company assets, because subsidiary are allowed to do transaction on its own. Subsidiary can hold assets and every other stuff. So therefore, subsidiary will do its job. Subsidiaries assets are there only. Liabilities, income, expense, everything is related to that company itself. Then where does the holding company come over there? Holding company come only for the profit distribution. And ultimately, how holding and subsidiary are connected? The investment made by holding company in their shares. Which means when it comes to translation, only net investment has got its impact. Because when it comes to branch and head office, branch assets are head office assets. Branch expense are head office expense. So there is a total control, total connection between the two. Here, there is connection between holding and subsidiary, but only to the extent of investment. Other than that, subsidiary will tell boss, this is my asset, this is my liability, you hold the control, no worries. But it is in my name only, it's not going to change. So therefore, when it comes to non-integral foreign operation, it relates to only to the extent of net investment made by the holding company over subsidiary. Now, the point to be understood for translation rules then. So for translation rules, I will only bring up the major impact over here. Number one, all balance sheet items. There is no bifurcation of monetary, non-monetary. Yeah, there is bifurcation of monetary, non-monetary, but everything, all balance sheet item, including monetary, non-monetary, every stuff will be done according to closing rate. Okay, entire balance sheet items will be done according to closing rate. Then what about income and expense? They are not balance sheet items. What about income and expense? They will be done according to average rate. Okay, these are the two major things which I wanted to tell. If there is a contingent liability, apply closing rate and all these things. That is normally going to work. Now, if at all there is any ERD when it comes to non-integral foreign operation. So integral P&L. So if there is any non-integral foreign operation, when it comes to ERD, it will be shifted to a reserve called as FCTR, Foreign Currency Translation Reserve. So any exchange rate differences arising in these situations will be directly shifted to FCTR, a reserve. Okay. Now the major job of FCTRs is not usable. You are not supposed to use this reserve for any purpose till disposal of investment or disposal of foreign operation. So till you dispose it, till you sell it off, till then foreign operation, you are not supposed to consider FCTR for any purpose. Only when you dispose it, that FCTR is allowed to be used. So that is the rule given under non-integral. So non-integral are other than integral. Second, there is no utmost control. And third, the total impact on the reporting enterprise is not going to happen. The impact is only to the extent of net investment. Therefore, translation rules are a bit different. All balance sheet items will come under closing rate. Then P&L item comes under average rate. Ultimately, if there is any ERD, it will be shifted to FCTR. So those are the translation rules what you have when it comes to operations. Now only one extra thing let's try to learn when it comes to this operation stage, and afterwards let's move to the next one, is about reclassification. Basically, initially when you started that off as an integral foreign operation. Later it was getting converted to non-integral. Case number one. Initially when you started it was non-integral, later you converted that to integral. So any of the two are possible. Now effect wise how it is going to happen, suppose if integral gets converted to non-integral, if integral gets converted to non-integral. Now just imagine if it's integral, normal rules are going to apply. What are they? Now only imagine balance sheet. If it's integral, what used to happen? Bifurcation is happening between what? Monetary, non-monetary. In that monetary closing rate, non-monetary historical rate, if you remember correct. But when it comes to non-integral foreign operation, there is no bifurcation of monetary, non-monetary. Everything is under closing rate. So what is that major shift? The historical cost non-monetary item is now getting converted to closing rate non-monetary item. So that is supposed to be done. So basically when integral is converted to non-integral, the non-monetary item of integral should be converted at closing rate and ERD shifted to FCTR. Okay, so basically when it comes to monetary doesn't matter. Both of them are closing rate only. Because if you see here, monetary closing rate, non-monetary historical rate. But non-integral everything closing rate. So therefore this historical is supposed to get converted to closing rate. That you do it. Once you do it, if you find any ERD, shift it to FCTR. Why? It is getting converted to non-integral. So that is how it is supposed to be done. The next one, if it is non-integral getting converted to integral. Now look into it, non-integral, all the item, monetary, non-monetary was done at closing rate. Integral, monetary closing rate, no problem. But non-monetary you have to come under historical rate. So should I now go back? Should I now convert the closing rate back to historical rate? No need. So therefore what they said is, date of conversion, whatever is the rate considered, that itself will become historical cost. Again, you need not shift this particular stuff. Whatever was there on the date of conversion, whatever was the amount, that itself will be now further continued as historical cost. Later in integral foreign operation, this won't be changed because it's a non-monetary item. But there is one more. Non-integral ERD is sitting in FCTR, but integral it could be used as P&L. So can I shift FCTR to P&L? The answer is no. They say FCTR will remain the same till disposal. Ultimate disposal has to take place for this thing to finish off. So this is how reclassification of integral and non-integral is supposed to be done. So if it is integral to non-integral, convert historical rate into closing rate, ERD, FCTR. Non-integral to integral, don't go back. Whatever is the conversion amount, that itself will be historical cost. FCTR is not allowed to be closed till you make the final disposal of the operation. So these are the operations mechanism what we have in AS11. The last part of AS11 talks about contracts, especially forward contracts. Okay, now what is going to happen in forward contracts related to AS11? So in this, forward contracts basically talks about exchange of currency on a future date. Exchange of currency on future date. Okay, we call them as forward contracts. So if there is a need of having or need of foreign currencies in future, you are going to enter into a contract now only, which will be executed in future. That will be called as a forward contract. Now, if I have to tell you the whole thing through an example, once I will give you the example and later let's move on with understanding what the standard tells us. The first part is, say, I will give you first example. The first example is, say you made a credit purchases. Okay, you made a credit purchases and payment is arising after 3 months. Payment is arising after 3 months. And you have a news saying that the price might fall. So your reporting currency, your main currency is going to fall in future, which means, say for example, current rate is 70 rupees, future it might be 77, assumption. In future, sitting now, I made a small calculation by myself and I am coming to a conclusion that it may turn into 77 rupees. So what happened? You wait for 3 months, 7 rupees extra per dollar you have to pay to your customer, because supplier, because supplier is going to collect amount in dollars. He doesn't care what is the exchange rate. He says, I want $10,000, you give it. So to arrange $10,000, you have to pay 70 rupees per dollar now. But if you want to do it after 3 months, extra 7 rupees is supposed to be paid. So what should I do it? Should I directly pay it now only? Not possible, because you have to utilize the credit period, right? You are getting credit period, utilize them. Simply, why will you pay it in advance? No, you don't want to do that. At the same time, buy the dollars right now and keep it. After 3 months, use this dollar and pay. Again, not possible, because laws are applicable in India whereby they will not allow you to keep foreign currencies just like that. So foreign currencies, you have to make sure that it will be surrendered if at all it is in excess, which means you need these money after 3 months. So what do? You find a person, you enter into a contract with that person whereby you will buy dollars from this person after 3 months. Today only you will enter into a contract saying that. So price fall is there. So therefore, what did you do? You entered into a contract. When you entered into a contract today itself, what did you say? You said that you are going to buy dollars after 3 months. Okay, so you went into a bank. There are different people who can enter into the forward contract. So you went to that person and you said, I will buy dollars from you after 3 months. How much is the price you are going to quote? So you asked for a price. Bank said, I will give it to you for 75 rupees. You felt that if I wait, I would feel that it is 77. My estimation is 77. Bank wants to give it at 75 itself. Good thing for me, you entered into a contract. This will now be called as forward. Okay, so what are you doing here? Your estimation of price will be there. You don't want to take any risk. You directly entered into a contract. You said that after 3 months I am going to buy it, and therefore give me dollars after 3 months. The other person say, okay, I will quote a price for you. If you will now think about it, you negotiate it, feel that the price is good enough, you enter into a contract. We call that as forward contract. So when this contract will be executed after 3 months, till then, no, it will still stay in papers. After 3 months, execution will start. Okay, I will give you another example. You find that now you are a market player. Now you find that there is price fluctuation in foreign currency. Okay, and in the near future, the fluctuation might increase even more. So what did you do? You don't want these dollars at all. You are not having any intention to have a dollar. You want to play with the change in foreign currencies. Okay, because you are a market player. So what did you do? There is no need for dollars for you. There is no payment, nothing. But still, you went into contract. You directly go to the bank or any person to that manner, you say, let's execute a forward contract $50,000 after 3 months. Then what do you do is, your intention is not to buy, but the intention is only to make profits out of fluctuation. Over here also forward contract comes into the picture. Okay, so 3 months executable forward contracts, you take it up, you start looking into price fluctuation. Based on the price fluctuation, you sell your contract to someone else who is in a need of dollar, and you come out of the contract. So here your intention is not to buy those dollars. Here your intention is only to take advantage of the price fluctuations. Both of them comes under forward contract. The first one, you call these things as hedging purpose. So what do you mean by hedging purpose? Hedging purpose is basically minimizing the losses or minimizing the risk. So hedging mentality is to minimize the risk. So in hedging, what is one of the major point to be considered? There is a need for foreign currency. There is a need for foreign currency. You don't want to take a lot of risk in future. You enter into a contract now only. You call that as hedging. What about the second one? The second one, this example is called as speculation. Because the intention over here, there is no need for foreign currency. There is only need for fluctuation. You only want to play on fluctuation mechanism. You don't have any other intention. So this will be called as speculation. Reason I am telling you this is because AS11 gives different rules for hedging, different rule for speculation. Okay, now what we need to see. I will use two terms over here. Try to understand that. Afterwards, I'll tell you about hedging and speculation. The first term is forward rate. Okay, what do you mean by forward rate? Forward rate over here basically means rate in the contract. Simple. So whatever rate is mentioned in the contract, call that as forward rate. As simple as that. The second one is called as spot rate. On the spot we say, no, something like that. Spot rate. Spot rate is basically rate on the date of entering contract. Okay, so here I will tell you that, see, when it comes to the example I told you, current rate is 70, I mentioned, that is spot rate. I want to enter it at 75, forward rate. So rate in the contract is forward rate. On the date you are entering the contract, which was the actual foreign currency rate, that is called a spot rate. Okay, so this is how forward rate and spot rate comes into the picture. Then the difference between the two, you call it as premium or discount. Just forward rate minus spot rate. We call them as premium or discount. Okay, now keeping this in mind, how do you deal with the rules on contract? One, if it is speculation. Okay, the first job when you have what you have to do if it's speculation is determine premium or discount. What is premium or discount? It is the difference between forward rate and spot rate. So determine premium or discount. Once that is done, this premium or discount should be written off over life of contract. Contract life is 4 months, write off 4 months, contract life is 2 months, write off against 2 months. So first calculate the premium or discount. This premium or discount should be written off over the period of life of the contract. Where will you write this off? It will be written off against P&L. Okay. Third, if at all you are going to cancel the contract in future, then penalty will be transferred to P&L. See, basically in forward contract what happens, it is executable after 3 months. Assume that there was a total market shift and after 3 months the foreign currency rate is lesser than forward rate. Then why will you go for forward rate? You estimated 77, bank said 75. So you said it's a good deal, let me enter into it. But actually on the date of making the payment, the rate is only 72. Then why will you go for bank and pay 3 rupee per dollar extra? You say it for bank saying that I want to cancel it, I don't want to enter it. Now bank will tell, okay, you cancel it, no problem, but you pay penalty for me because you are entered into a contract. There is a breach of contract. So pay penalty. Okay, pay penalty and close it off. That penalty is a loss to me which will be transferred to P&L. So this is the rule applicable for hedging purpose. Okay, I made a mistake by writing speculation. This is the rule for hedging purpose. So for hedging purpose, first calculate premium or discount, and afterwards write this premium or discount over the life of the contract. Third, if there is any cancellation, penalty will be levied, that will be transferred to P&L again. So this is again, I repeat, this is for hedging purpose and not speculation. The next one is speculation. From the speculation point of view, premium or discount is ignored. Leave it. You don't want it at all. Okay, leave premium or discount, not needed. Second, profit or loss is calculated as comparison to sales minus forward rate. Because in speculation, the intention is not to purchase dollar. Intention is to take advantage of the price fluctuation. So therefore, selling price, you are going to sell this contract to some Mr. A person. Selling price minus forward rate will be your profit or loss. Determined at that time only. So therefore, profit or loss is determined at the time of sale. This is for speculation. Do not consider premium or discount. Directly consider the profit or loss during sale itself, and the calculation is selling price minus forward rate. So spot rate mindset is not needed when it comes to speculation transaction. So hedging, speculation. So these are the contract requirements whenever you deal with AS11 segment. With that, AS11, all the theory is over. So we consider transaction rules, then we consider translation rules, contract rules. So all the rules and regulations are done when it comes to AS11. So now we have to take up a problem and we will see how problems are supposed to be solved when it comes to this particular AS and how it could be done. So let's start with the questions now. Home Limited purchased an item of property, plant and equipment for US $50 lakh on 1/4/2019, and the same was fully financed by the foreign currency loan US dollar, repayable in 5 equal installments annually. Exchange rate at the time of purchase was $1 is 60 rupees. As on 31/3/20, the first installment was paid when $1 fetched 62 rupees. The entire loss on exchange was included in cost of goods sold. Home Limited normally provides depreciation on an item of property, plant and equipment at 20% on WDV and exercise the option to adjust the cost of asset for exchange difference arising out of loan restatement and payment. Calculate the amount of exchange loss and its treatment and depreciation on this item of property, plant and equipment. Okay, so now this is the question which is given to you. First, read the question. To some extent, you may feel this confused. This is an MTP question. So read the question once. You'll first understand that and then you can go with the interpretation of the answer. First, they purchased a property, plant and equipment. So basically, it's a fixed asset for $50 lakh. Fair enough. Then it has been taken up through a foreign currency loan. So do we remember? Depreciable asset is purchased out of foreign currency loan. Then there is an option given by MCA. What is that option? ERD can be taken to cost of the asset. That is the option given by the standard. So you can consider that also. So now let's see what they have done. So date of loan, it is 60 rupees per dollar. That is how they have considered. And on 31/3/2020, the first installment was paid. Okay. Entire loss was included in cost of goods sold. Now, do we have any option when it comes to ERD to adjust it to cost of goods sold? The answer is no. ERD has got only two interpretations. Either one, take it to P&L, or two, adjust it to cost of the asset. Nowhere in the standard it mentions about adjustment to COGS. So that basically means what the company has done is wrong. They are not supposed to do this. Then what are they supposed to do? See, Home Limited normally provides depreciation, okay, and the depreciation rate is given. Exercise the option to adjust the cost of the asset for exchange difference. So what are they telling? They are telling that I have chosen that option. What is that option? You find ERD, adjust it to cost of the asset. Once you choose the option, you have to continue it consistently. You are not supposed to change it. So therefore, now they are saying that they are adjusting it to cost of the asset. Accordingly, you have to deal with it. So they are asking amount of exchange loss, treatment, depreciation. Okay, three things has been asked. Now, amount of exchange loss, how do I get it? A total of 50 lakh dollars you have into 62 minus 60. 50 lakh dollars you have, yeah, US dollar 50 lakh, correct. So 50 lakh dollars you have, 62 rupees minus 60. So 2 rupee per dollar is the exchange rate difference. So accordingly, it has to be considered. So if I read it over here, exchange rate differences arising on restatement of liabilities incurred for the purpose of acquiring an item of property, plant and equipment should be adjusted in the carrying amount of respective item of property, plant and equipment. Okay, so that is how you are supposed to deal with it. So 2 rupee per dollar is supposed to be our exchange rate difference. Now, accordingly, how do we do it then? Just look into it. 50 lakh dollars is there, right? That is the amount of loan. And later, what is happening? 10 lakh dollars has been paid because first installment was paid on the last day of the year. And what they are saying, it is payable in 5 equal installment, which means 50 lakh by 5 is 10 lakh dollar. 10 lakh dollars has been paid. So as on the balance sheet date, what is the outstanding amount of loan? The outstanding amount of loan is 40 lakh dollars. I hope everybody are following me. 50 lakh divided by 5. So 10 lakh dollar came in, this has been paid. So 40 lakh dollar remain. 40 lakh dollar 2 rupee per dollar, 80 lakh rupees is the exchange rate difference. So that has been said over here. See, foreign currency loan 50 lakh dollars into 60, 3 lakh rupees. Exchange loss is 40 lakh dollars into 62 minus 60. Just 2 rupee per dollar is 80 lakh. Okay, what should we do with this exchange rate difference? Add it to the cost of the property, plant and equipment. Okay, so basically this 80 lakh will be increase in the loan also. At the same time, it is increase in the cost of the asset also. So both of them will be added up instead of transferring ERD to P&L. So that is how this entire stuff is supposed to be done. Okay, so this is how you are supposed to deal with it. Now, ultimately, if you could look into here, they are adding one more sentence. The total cost of property, plant and equipment to be increased by 100 lakh rupees. Now, why 100 lakh rupee comes into the picture? Now, if you read the sentences, you will understand what explanation I gave. But I will only now give more importance towards numbers. How did 100 lakh come into the picture? See, 80 lakh rupees is your exchange rate difference on loan. Okay, now what is happening with this 10 lakh dollars which is getting repaid? 10 lakh dollars is getting repaid, and during repayment also ERD will come. If you remember, I had already told you, you took the loan at 60 rupees, you are repaying the loan at 62 rupees into 2 is rupees 20 lakh. Means exchange rate difference is not just that monetary non-monetary aspect. Exchange rate difference will come during settlement also. Even that exchange rate difference will also be shifted to cost of the asset. So therefore, it's 80 lakh plus 20 lakh, which is 100 lakh. Okay. Then for depreciation purpose, what should I do? 3000 lakh, which is the original value of the asset, plus 100 lakh into 20%, which is according to the rate prescribed in the question. So this is how it is supposed to be done. So I will summarize this answer then. 1. Adjustment to cost of goods sold is not possible. It is wrong. Second, since they have chosen the option it should be taken, or the exchange rate difference should be adjusted to cost of the asset. Here 60 rupee loan is getting converted to 62 rupees, which means 2 rupee loan is increasing. If that is the case, if I have to pass a journal entry for this, what will happen? 2 loan it will take place, because loan is liability. Debit will be given to ERD. Later what you will do? To ERD, because you want to close ERD, debit will be given to what? Fixed asset. So automatically what happened? Asset increased, liability increased. Okay, so you have to add it to the asset. So that is how it should be done. So once you deal with that, once you make the addition is not just with the loan amount, it's also the settlement amount as well. Later, after addition, calculate depreciation. So that is the entire summary of the answers what we need to write. Sentence wise, yes, it is anyhow, I will be sharing it with you. You can look into this for the sentence framework. Okay, now we will take up another question. This is your RTP question which is prescribed. Goods purchased on 1119 US dollar 15,000, exchange rate 75, exchange rate on 31/3/19 74, date of actual payment is 73. You are required to ascertain the gain or loss to be recognized for financial year 1819 and 1920 as per AS 11. First, goods purchased and payment is made on 7/7. So this basically means it is credit purchases. Since it is credit purchases, automatically what happens? Recognition will be done at 75. Okay, then this creditor is my monetary item. Creditor is a monetary item, which means it should be restated. So 75 rupee should now be converted to 74 rupees. 1 rupee per dollar. 1 rupee per dollar, total dollar involved is 15,000. So 15,000 ERD will be shifted to P&L. Okay, first, is this a gain or a loss to me? What journal entry will I pass for this? If 75 is now getting converted to 74, creditor worth 75 is now getting converted to 74, reduction. So creditor will be debited. Liability is reducing. Credit is given to ERD. Later, ERD will be shifted to P&L, which means this is a gain for you. Not a loss this time, it's a gain. Reduction of liability is income for us. So that is how it should be done. So 1 rupee. Next year, when the payment is made, 74 is now getting converted to 73. Compare 74 and 73, not 75 and 73. So 74 is now getting converted to 73. Another 1 rupee gain, 15,000 again ERD. That has to be considered. So that is what is written over here. So initial it will be 15,000 into 75, 11,25,000. Afterwards, 15,000 rupee profit will be shifted to P&L account. Finally, even payment time also 15,000 profit is credited to P&L account. So that is how you have to consider it. Statement wise, first you have to tell AS 11 about the transaction rules. So basically, asset or liability or transaction is recognized on the exchange rate as on the date of transaction. Afterwards, you have to tell about monetary, non-monetary. Then monetary rule saying that it should be restated. Accordingly, the answer will come into the picture. So this is how you have to answer an AS 11 question whenever it is asked for you. So basically, you have to first go through that rules properly. Once the rules is understood, automatically it could be converted into our answering part and it could be taken up over there. Okay, so this is how you are supposed to deal with the answering element when it comes to AS 11. So this is the end of AS 11. Now we have to move on with yet another accounting standard, and we have to see how that accounting standard should be dealt with. Before we start off with the next standard, which is AS 13, let's quickly look into that highlight points which I normally tell. So in this, the highlight points needed are: number one, the definitions involved. What do you mean by foreign currency? What do you mean by reporting currency and all? Second one, transaction rules. In this transaction rules, number one, date of initial transaction. So what will you do with that? Then what will you do with balance sheet date? Is monetary, non-monetary. And how will you treat exchange rate difference for transaction rules? Then afterwards, third, translation rules. In that, how will you deal with integral foreign operation? How will you deal with non-integral foreign operation? How will you deal ERD under these both situation? Then how will you handle reclassification? Then after that, you will have your contract mechanism. First, how to decide what do you mean by a forward contract. Then terms involved in this. So important terms involved in this. Then how will you deal with hedging purpose? Then last, how will you deal with speculation purpose? So this is how you have to deal with AS11 segment. Once you look into the highlight points, you will automatically start connecting what we have done in the standard. Okay.